In this video, I'm going to provide an overview of debits and credits as well as a simplified approach as to how these concepts work. Let's get started. When discussing debits and credits, it's important to understand that the left side of an account is the debit side, and the right side of an account is the credit side. When we enter amounts on the left side of an account, this is known as debiting the account, and when we enter amounts on the right side, this is known as crediting the account. When we say debit or credit, these terms by themselves don't mean plus or minus or increase or decrease. When an account is debited or credited, it depends on the account itself whether the entry constitutes an increase or decrease to the account balance. We use debits and credits to show the effects of real-world economic transactions, which will ultimately be displayed in the financial statements. The difference between total debits and total credits for an account, including any beginning balance, is the account balance. Debits and credits are part of the double entry system of accounting. Double entry accounting demands that the accounting equation will always be in balance. This means that for every transaction, at least two accounts will be involved, and there will always be at a minimum at least one debit and one credit. The total amount debited will always equal the total amount credited for the transaction. We can gain a better understanding of this by taking a look at the accounting equation. The accounting equation is denoted as assets equals liabilities plus shareholders' equity. Common stock, dividends, revenues, and expenses are components of shareholders' equity, and thus the accounting equation can be rewritten as assets equals liabilities plus common stock minus dividends plus revenues minus expenses. We can simplify this by rewriting the equation as assets plus dividends plus expenses equals liabilities plus common stock plus revenues. Notice how we moved the components of shareholders' equity in the equation. We moved dividends and expenses to the left side of the equation and kept common stock and revenues on the right side. This is because dividends and expenses decrease shareholders' equity, while common stock and revenues increase shareholders' equity. The left side of the equation, which is made up of assets, dividends, and expenses, will normally have a debit balance. Therefore, these accounts increase when debited and decrease when credited. The right side of the equation is composed of liabilities, common stock, and revenues. These accounts will normally have a credit balance. Therefore, these accounts will increase when credited and decrease when debited. This information is important to remember when dealing with debits and credits. Whatever way you want to memorize this is up to you. For me personally, I just remember the acronym DED, which stands for Debit, Assets, Dividends, and Expenses. This allows me to only have to memorize a short acronym that reminds me to normally debit assets, dividends, and expenses in order to increase these account balances. Then, for the other three account types, you know the opposite situation applies, which is to credit the other three in order to increase the balances. However you choose to memorize these is up to you. This is just what I prefer to do. Once you do more problems and encounter situations in real life, this will become more intuitive and easy to know. I know I provided a good amount of information at this point, and I want to leave you with a couple examples to help reinforce your understanding of debits and credits. Net increases or decreases on one side of the accounting equation must have equal net effects on the other side. So let's say a shareholder contributes $500,000 to open a business. Assets will increase by $500,000, so we will debit the cash account, which is an asset, by $500,000. We will also credit the common stock account by $500,000 to represent the shareholder interest in the business. Both sides of the equation won't always be affected for each transaction. Some transactions only affect one side of the equation, which is completely fine as long as the net effect of the transaction is zero, or else it would throw off the balance of the accounting equation. For instance, the business could use $300,000 of this cash and proceed to buy a building in an all-cash offer. To demonstrate how this transaction would be accounted for is a debit to the buildings account by $300,000. A credit would be made to the cash account for $300,000 as the cash account will decrease by this amount in order to purchase the building asset. I hope you found this video useful.